You said you obviously went through the great financial crisis. You learned some lessons. Right now, the last couple of years, and it's been pretty incredible what's happened in the real estate market. And a lot of people, we mentioned before you were recording that some people will also learn, I guess, some lessons, or maybe the economy might be going through a change or something like that. If we step into a situation like this with new investors that maybe are going to learn some lessons as the people are underwater, I believe is what the conversation was. What lessons could they learn, or did you learn that maybe could benefit them?
I think there's two things you need when you have a distressed piece of real estate. One is a plan.
Mm-hmm.
And then two, that plan generally will entail the need for capital. So you need a plan and then you need money to execute that plan. And if you have those two things, you normally can, with a logical counterparty, right? In this case, your lender, can work out a fair solution to reset the capital stack.
Right. Because they don't want to take that property back.
No. Look, lenders, banks, insurance companies, they're not equipped to go out and run real estate, especially local pieces of real estate, which require rolling your sleeves up and getting dirty. We've real estate over the last 25 years has turned into kind of a very sexy institutional business, but it's really kind of a gritty asset class. You've got to roll up your sleeves. You've got to improve things. You've got to lease space. All those things are hand-to-hand combat. They're not these kind of big things, concepts that are talked about in the Wall Street Journal or Bloomberg. They're the day-to-day grind of what it takes to turn a property from underperforming into a performing piece of real estate. And so banks, and they're just not set up to do it. It's a different skill set. It's a different mindset. And generally you have to be local too, right? I mean, imagine running a little office building in Plantation, Florida from New York City. Like how are you going to do that?
Right. Yeah. So, I mean, it is very that, like what you just said. So like the last few years, it's been quite the opposite. Most people thought that real estate's the sexiest, easiest way to get rich. And a lot of people were just, they would enter the space. They would try to buy something with very little game plan or very little experience. But I guess ultimately during these periods in which there's maybe a little bit more hesitancy, it comes more opportunity to make create a lot of value.
Right. As a value buyer, these are the moments you wait for, right? The last several years, money was easy. You could go and find financing for cheap. You could pass the hat around to your friends to raise equity because everyone thought it was easy. And now the market is not only cost more, but it's liquidity has been sapped from it. And so, we always focus on two things when we're looking at what drives real estate value. One is the cost of capital, i.e. interest rates, and the other is the availability of it, liquidity. They're both extremely important, but we've always believed that liquidity is more important than the cost of capital. Because when there's no liquidity, that cost of capital goes up because people can charge more for it, for the money, et cetera, et cetera. And when the market's liquid, those spreads start getting condensed. So right now, the market is expensive and it's illiquid. So if you're sitting on a lot of capital, you have opportunity.
Definitely.
If you have to go out and raise money, good luck.
Yeah, it's definitely I think we're stepping into probably one of the best periods ever to raise money if you can raise it.
Yeah, it's if you can raise it. I think raising money is very difficult right now. You've got, capital really comes from two places: the institutional world and then private capital, the individuals. Both of those groups are hesitant at the moment in time. So having a platform that has existing investors, that has existing capital, is those are the groups that are going to have the most opportunity right now because they have capital to go invest into this market.
Got it. Where do you mentioned interest rates? Where do you think interest rates could be headed in the next? Do you think that they're going to hit a pause potentially? And I guess no one can predict, but in the next 6 months?
Yeah, look, they're slowing down. Whether they go up a little bit or stay exactly where they are, I don't think it really matters much at this point in time. Like most of it's in there. I think right now it's the thing we're looking at is how long do they stay up for before they have to come down. If you look at the forward curves, it looks like it's a pretty short duration for them to stay high before they drop them pretty quickly. I think they're going to stay higher longer. That's just speculation.
Yeah.
I don't think
Carl Icahn was saying the same thing.
Yeah.
He was saying he thinks that they're probably going to stay a little bit more stubborn than most people are anticipating.
Yeah, I look, the economy for whatever reason has been resilient, right? It hasn't kind of necessarily pulled back in the manner you'd expect it to. Not that it hasn't some, but it hasn't pulled back in the manner you expected it to. But I think for a group like ours, obviously at some point you need them to come down because we want to sell those assets at some point. But the longer the duration that they stay elevated, the more opportunity for us.
Definitely.
Because the more pain in the market.
Of course. And the higher the interest rates, as you mentioned, the higher cost of capital, the less the building is actually going to yield on the resale market. The market likely will, I believe, reprice these assets based on lower interest rates later point in time.
Right.
If you've enjoyed this clip and you'd like to watch the full episode, you can do so on my main YouTube channel by clicking the video here.